How to save money for major financial goals. Many of us have a natural tendency to spend money. However, saving can take some practice. This video provides practical guidance on how and where to save for three major goals: financial emergencies, college, and retirement. However, the tactics outlined can be used to a variety of other goals, including saving for a new car, a down payment on a home, a dream vacation, or starting your own business. However, before you get started, you should review any existing bills. It makes little sense to pay 17% interest on credit card debt while earning only 1% or less in some situations in a savings account. Consider tackling both at the same time, putting money towards savings and credit debt. The sooner you pay off that high interest debt, the sooner you'll need to increase your savings. Building emergency savings. Most individuals and families should aim for an emergency fund large enough to cover major unexpected expenses, such as an expensive auto repair, hospital bill, or both. If you lose your job and have to look for another, an emergency fund can help you get by for a while. How much should you save? Unless you're already a huge saver, your take-home income is a good estimate of your monthly living expenditures, and it's easy to find on pay stubs or bank statements. Financial advisors typically recommend saving at least 3 months' worth of living costs. Others recommend putting away anywhere from 6 months to a year's worth of expenses. These figures apply to retirees as well. However, it's usually a good idea to perform a few additional computations. Consider all of your monthly expenses versus your monthly income, which includes Social Security, pensions, liquid assets, and investment income. You should also consider the risk involved with any stocks or other volatile investments you own during a bear market. Where to park your cash. To ensure quick access to your money in an emergency, store it in a liquid account, such as a checking, savings, or money market account at a bank or credit union, or a money market fund at a mutual fund company or brokerage firm. If the account earns some interest, all the better. Funding your account. Consider using all or some of the money you earn outside of your regular income. This might be a tax return, a bonus, or income from a side gig. If you get a raise, attempt to put a portion of it to your account as well. Another time-tested approach is to pay yourself first. This entails treating your savings account as if it were a bill and allocating a set percentage of each paycheck to it. To avoid the temptation to simply spend the money, try direct deposit. Alternatively, you can have money placed into your checking account and then automatically transferred to your emergency fund. Many of us find it easier to say than to do when it comes to saving for unforeseen circumstances. For example, someone earning $50,000 per year would need to set aside anywhere from $12,500 to $25,000. If they set aside 10% for emergency savings, it would take 2.5 years in the first case and 5 years in the second, excluding any further contributions or income the account may earn. Saving for retirement. Retirement is the single most important savings objective for many of us. However, the challenge can be frightening. Fortunately, there are various effective strategies to save money, several of which offer tax breaks as an added incentive. In addition to a bank or credit union savings account, almost everyone can open an individual retirement account, IRA. Tax-advantaged accounts include 401k, plans for private sector employees, and 403b, plans for employees of schools and non-profit organizations. Employer-sponsored plans. The simplest and most automatic way to save for retirement is through an employer plan, such as a 401k. The money is automatically deducted from your paycheck, and invested in the mutual funds or other investments you have chosen. You don't have to pay income taxes on that money, the interest, or any dividends your plan earns until you withdraw it. For 2023, you can contribute up to $22,500 per year to a 401k plan. If you are 50 or older, you can pay an additional $7,500 for 2023 and 2024. As an additional incentive, many employers will match your payments up to a specific amount. If your employer contributes another 50%, your $10,000 investment will be worth $15,000. Saving for college. College may be the second most important savings objective for many of us, and like retirement, the most efficient way to save for it is to do it automatically. Saving for life goals. Most of us have multiple savings goals at any given moment, and only a limited amount of money to split between them. If you are saving for retirement and a child's college at the same time, you should consider a Roth IRA. Unlike traditional IRAs, Roth IRAs allow you to withdraw your contributions, but not the returns, at any time. If you're under 59, you may be subject to a penalty for early withdrawals, so do your research. Tips for saving money. If you need to save more money than you can easily pry out of your paycheck, here are a few ideas that financial planners often suggest to consumers. 1. Manage your spending. People frequently find themselves wasting money on goods they don't need and could easily live without. Record every money you spend for a set period of time, whether it's a week or a month. You can keep track of your expenses in a notepad or with an app like Clarity Money or Wally. Some apps will even save for you. For example, the Acorns app connects to your payment card, rounding up your transactions to the nearest dollar and transferring the difference to an investment account. 2. Consider cashback. Signing up for apps like Ibotta or Rakuten may make sense if you only buy items that you genuinely need. Apps like these provide cash back from retailers on groceries, apparel, beauty supplies, and other purchases. You can also utilize a cash rewards credit card, which provides 1% to 6% cash back on every transaction. For example, the Chase Freedom Card provides 5% cash rewards in areas that rotate occasionally. This strategy is only effective if you move your funds to a savings account and pay your credit card bill in full every month. 3. Focus on major expenses. Clipping coupons is excellent, but you'll save a lot more money by cutting back on your major expenses. For the majority of us, that includes housing, insurance, and transportation costs. Can you save money by refinancing your mortgage at a lower interest rate? Could you look around for lower premiums or combine all of your insurance with one carrier to get a discount? If you travel to work, is there a less expensive option, such as carpooling or working from home once a week? 4. Do not get crazy. You could want to eat out less frequently, attempt to get a few more wears out of your clothes, or keep driving the old car for another year. But unless you prefer living as a miser, which some people do, don't deprive yourself of every last pleasure in life. The goal of saving money is to guarantee your financial future, not to make yourself unhappy in the present. What's the best way to save money? To save money, you must exercise discipline and follow a strategy. Understand your objectives and how much you need to set away. Take advantage of the options available to you, whether they are employer-sponsored retirement accounts or individual retirement accounts, IRAs. Make sure you have assets that can be easily liquidated in case you need money in an emergency. Also, visit a financial specialist to help guide you in the proper route. The bottom line: saving money is essential for a solid financial future, one with minimum debt that allows you to live comfortably while building wealth. As life progresses, numerous significant expenses arise, such as paying for school, a home, your child's education, and retirement. Using a range of saving tactics for each occasion will allow you to tackle these expenses in a responsible financial manner. As we conclude our financial education journey, remember that mastering your finances is a lifelong process. By equipping yourself with knowledge and making informed decisions, you pave the way for financial stability and prosperity. Whether it's budgeting, investing, or planning for retirement, the principles of financial literacy empower you to take control of your economic future. Keep learning, stay disciplined, and embrace the opportunities that come your way. Here's to your financial success. If you enjoyed the video, please give it a thumbs up. Don't forget to subscribe for more content like this.